All right. So welcome all. Today's session is going to be on reading and understanding the financial statements. So it builds upon the session from last week. Last week we looked at how the three financial statements are constructed. I went over the line items on the three on all the three financial statements: the income statement, the balance sheet, and the cash flow statement. As we go through the session, if you don't understand like some particular term, or if you don't understand like some line item on some financial statement, just feel free to text me on Zoom. I'd appreciate if you could send me a text on Zoom as opposed to unmuting yourself, because that'll just I think that'll be a better way for me to answer the questions, because maybe a question that you have would be answered later in the session. But I'll make sure to address every single question that you have. So if you haven't done the check-in, I'd appreciate if you could do so, but we'll move forward. So today's session objectives are exploring the linkages between the three financial statements. So the income statement, the balance sheet, and cash flow statement. This is a very important topic because this is something that's heavily tested on the interviews, and also it's very critical to understand what collectively the financial statements, like what picture do all the financial statements present as we analyze the financial statements or the financial health of a particular company that we're looking at. And then we'll see how the 10K report is organized and how to read it. If you don't know what a 10K is right now, it's totally fine. I don't expect you to know it. And then we'll go over an exercise on how to actually construct a financial statement. And this will be a nice refresher from last week. So I'll give a brief overview of the income statement, the balance sheet, and the cash flow statements just orally, just to review what we covered last week. So the income statement is basically the statement of profitability or the statement of operations of a company. So it starts with the revenue, and then there's direct costs. So the direct cost is usually the cost associated with the production of a particular product or service. So it includes the cost of goods sold and also any direct labor associated with the production of the product. And then that gives you the gross profit. And then we deduct the indirect expenses, which is usually the operating expenses. So the SG&A is what we call it. So it includes marketing, it includes distribution, it includes any R&D, it includes the wages of employees, any admin work, or any office rent and stuff like that. So it's all included in the SG&A. And then we subtract that from the gross profit to get to the EBITDA, so earnings before interest, taxes, depreciation, and amortization. And that gives us, and then we deduct the depreciation and amortization, which gives us the EBIT, which is also the operating income. And then we deduct interest expense and add back interest income. That gives us the EBT, earnings before taxes, and then we deduct the taxes to get to the net income. And then the balance sheet is a very important thing to know about the balance sheet is that it balances. So there's the equation, which is assets is equal to liabilities plus shareholders' equity. A better way to look at the accounting equation is to look at it as assets minus liabilities is equal to shareholders' equity. Assets is what you own, and liabilities is what you owe. And shareholders' equity is what the company is worth after all the liabilities are paid off. So that equation makes sense. And then so the balance sheet is divided into assets, liabilities, and shareholders' equity. Assets and liabilities are current and non-current, depending on the time frame. So if it's within a year, it's current, and if it's not within a year, it's non-current. And then the cash flow statement is divided into three sections: cash flow from operating activities, cash flow from investing activities, and then cash flow from financing activities. There's two ways to calculate the cash flow from operating activities. There's the direct method and there's the indirect method. The indirect method just uses the net income from the income statement and then makes any additions for any non-cash expenses. And then that gives us the the cash flow from operating activities. And then there's only one way to calculate the financing and investing activities cash flow. And we looked at accrual accounting, which gives which is the reason why we have a separate income statement and a cash flow statement, because everything that's accounted for in the income statement is not necessarily in cash, because we're using the principle of accrual accounting, and accrual accounting is the standard set by GAAP. which is the generally accepted accounting principle set by the FASB, Federal Accounting Standards Board, and that is what all of the US public companies have to use. So that's pretty much what we covered last week. Any questions so far? Any questions on last week's session or anything that you didn't understand? Any particular term, or I'm happy to go over anything again. And if you didn't attend the last week's session and still have questions about anything that was covered, feel free to ask, because I want to help as much as I can. You can unmute yourself and ask. Nothing. Okay, awesome. So now we'll be exploring the linkages between the three financial statements. So firstly, we'll, and make sure that you take notes, because this is something that you'll be asked in the interviews for sure. It's mostly investment banking, but also it's very important to know for a sales and trading role, and also the wealth management and asset management roles. So someone asked, what does Ppne stand for? So I haven't gone over the slide yet, so I'll be explaining as I go over it. Okay, so if you don't have any other questions, I'll begin with the links between the three financial statements. And by the end of the session, and also as you practice more, you should be really comfortable with, how the financial statements are linked, because that'll really help you understand, the story behind the financial performance of a company. Okay, so we'll start with the income statement on the balance sheet. So the net income, as explained, which is the bottom line on the income statement, flows into the shareholders' equity account on the balance sheet through the retained earnings account. So as explained last week, shareholders' equity is made up of retained earnings and also common stock. So the net income flows into the shareholders' equity in the retained earnings account. So the retained earnings is basically just a cumulative sum of the net income from the past years. So the retained earnings this year would be last year's retained earnings plus the net income from this year, and then it just accumulates. And the net, and a more precise way to look at it is that the net income flows into the shareholders' equity in the retained earnings account after dividends have been deducted. So you deduct the dividends from the net income, and then you add that to the retained earnings account. Any questions so far? And again, it is important that you know what shareholders' equity is and what net income is. That's why I covered that last week. But if you still have questions, then just text me on Zoom. So the second link is that the depreciation and amortization flow from the Ppne schedule on the balance sheet. Let me see. Yes, the Ppne schedule on the balance sheet, but it is an expense on the income statement. So there are two basic terms here. So depreciation and amortization. Depreciation and amortization result again from accrual accounting, because if we buy a factory or if we buy a machine, for example, that will last us for more than a year, we have to expense that over the life of that asset. So if a machine costed us $100 and it'll last us for 5 years, we'll depreciate $20 every week, assuming we're using straight line depreciation. So the Ppne is property, plant, and equipment. It is an account in which we account for any machinery or any factory or any physical capital that the company has. So it's usually large any factory or machinery or stuff like that. So so the Ppne is on the income statement. Could anyone tell me where is on the balance sheet? Could anyone tell me where on the balance sheet exactly? Yeah, you can go ahead and unmute yourself.
Is it under non-current assets?
Absolutely, yeah, perfect. So it's a long-term asset, so it goes under the non-current asset account on the balance sheet. So the third link is that the interest expense on the debt that is in the balance sheet is an expense on the income statement. So firstly, the debt is accounted for in the non-current liabilities account on the balance sheet, and any interest that is charged on that debt that you hold is an expense on the income statement. So remember, we calculated the operating income, which is the EBIT, earnings before interest and taxes, and then we deducted the interest expense. So the interest expense is basically on all the debt that is on the balance sheet. Okay, so the next link is that the inventory on the balance sheet is expensed as cost of goods sold on the income statement. So last week I talked about the matching principle, that the expenses could only be recognized when the associated revenue is earned. When we buy some inventory, we cannot recognize that as an expense on the income statement because we haven't sold that out yet. So we haven't generated any revenue from that yet. So when we generate some revenue from the inventory by selling it off, that inventory goes under the cost of goods sold on the income statement. So those are the 4 main links. Any questions on the linkages between the income statement and the balance sheet? No question is stupid question, so just shoot. Okay, awesome. Okay, so next up, we'll explore the linkages between the balance sheet and the cash flow statement. So the first link is that the capex from the cash flow from investing flows into the PP&E on the balance sheet. So again, 2 terms, capex and cash flow from investing. So capex is basically the capital expenditures, and I talked about it last week. So when you spend some money to buy any non-current asset, be it like machinery or a factory or stuff like that, that is recognized as the capital expenditure because you're making some expenditure to buy some capital. So it's pretty intuitive. So that's accounted for under the cash flow from investing. It's a cash outflow. And the asset that we generate from spending that money is a non-current asset, which is a PP&E. So you spend some money, which is the capex, to gain an asset, which is PP&E on the balance sheet.
In 1 second, where is capex again? Where can you find capex initially?
Capex is in the cash flow from investing on the cash flow statement. So remember how the cash flow statement is divided into 3 categories. So under the investing category. Awesome. So working capital on the balance sheet flows into the cash flow from operations. So working capital is a very important term that is thrown around and that I think everyone should know about. So working capital is basically the formula is current assets minus current liabilities. And you should all like remember this formula because it's really important. And working capital is a term that usually impresses the interviewers. And this particular link that I'm going to talk about, so the working capital on the balance sheet flows into the cash flow from operations. It's not something that most people talk about in interviews, so it could help you, stand out from the rest of the crowd. So working capital is current assets minus current liabilities, and usually the current assets that we look at are accounts receivable and inventory, and the current liabilities that we look at is accounts payable. So the formula turns out to be working capital is equal to accounts receivable plus inventory minus accounts payable. So it is an account which measures the liquidity of the company or the short-term financial health of a company or the operational efficiency of the company. So what liquidity is that it's a measure of how easy actually, let me phrase that in an easier way. So liquidity just gives you a picture of how easy it is for you to actually have cash. So for example, a factory is non-liquid because it is very hard to turn that into cash in the short term. And inventory is more liquid because it is easier to sell off inventory and turn that into cash. So liquidity is just a measure of how easy it is for you to access cash. So working capital is accounts receivable plus inventory minus accounts payable. So remember how in the cash flow from operations, we have the net income and then we deduct any non-cash, and then we add back any non-cash expenses. So as I talked about in last week, accounts receivable and accounts payable are non-cash expenses because they're accounts generated from the accrual accounting principle. So that's why we add that back in the cash flow from operations. And this is a point I'll also demonstrate in Excel if most people have, not a clear understanding of it. Because this is like, I think the hardest link to actually understand. So when I go through like all the linkages, if you still don't understand it, I'll be happy to demonstrate that in Excel. Okay, so the next thing is that the depreciation and amortization flows out from the Ppne schedule and is added back in the cash flow from operations calculation. So remember also the depreciation and amortization are an expense on the income statement, but because they're non-cash, they come out from the same schedule, but on the cash flow statement, they're added back to the net income because they're non-cash. So they were recognized as an expense on the income statement, but because they're they're a non-cash expense, they're added back when we calculate the cash flow from operations on the cash flow statement. Any questions? I think these linkages are probably the hardest one, so I'll be sure to stop after every link.
So we have the expense. So depreciation and amortization are expenses on the income statement, right? And they're added back into operations and cash flow.
Yeah. And for example, if you have had revenues of $100 and you had direct costs of $30, so the gross profit is $70, and then you had indirect costs of $20. The EBITDA margin is $50, not margin, EBITDA value is $50. And then you deduct depreciation and amortization, for example, of $10. So that results you that makes you stand at $40. And then like all the interest and tax calculations and stuff. But so if we neglect that, so this $40 in net income is the first line on the cash flow from operations calculation. But because the depreciation and amortization was a non-cash expense, but it was deducted in the income statement, so we have to add it back. So we'll add the $10 that we deducted in the income statement here in the cash flow statement to give us the actual cash flow picture. So the $50 would be the cash flow from operations. And I'll be happy to demonstrate everything in Excel. So the next point is that the changes in debt holdings on the balance sheet are reflected in the cash flow from financing in the cash flow statement. So cash flow from financing is divided basically into two parts. So a company has two ways to raise capital, either through equity or debt. And equity is basically just issuing more shares, and debt is just taking on more debt. So any changes in your debt holdings, so if you take on more debt, and there'll be a liability on the balance sheet, but is reflected as a line item on the cash flow from financing activities in the cash flow statement. Any questions so far? For you to understand all this, it's really important that you really understand, how the three financial statements work. And that's why I covered that last week. Okay, so the next point is that the net cash flow from the cash flow statement is added to the opening balance on the balance sheet, which results in the closing cash balance. So as I talked about in last week about this, so the balance sheet is just a snapshot of a company's financial health. So it is not over a period of time, but it is in a point in time. So we have two balance sheets, the opening balance sheet and the closing balance sheet, just to cover that financial period that we're looking at. So the opening cash balance, so the net cash flow from that period is added to the opening cash balance on the balance sheet, which results in the closing cash balance for the closing balance sheet for that year. So if in January we had $100 on our balance sheet, And throughout that year, we generated 150 more. So the opening cash balance is 100. Then we add the cash flow from that year, which is 150, and that'll give us the closing cash balance for that year, which is 250. Any questions on this? No. And again, feel free to ask like any question. I'll be happy to go over again. I'll go over everything again. Okay. So the next one is pretty simple. The links between the income statement and the cash flow statement. So as I said, the net income, which is the bottom line on the income statement, or the last line on the income statement, is the first line in the cash flow from operations calculation on the cash flow statement. And depreciation and amortization is a common element in both the income statement and the balance sheet, but this should be deducted, not dedicated. I'm sorry for that typo, but it is deducted on the income statement because it is an expense, but because it is a non-cash expense, we add that back on the cash flow statement. So that's pretty much how the three financial statements are linked. How's everyone doing?
I'm very confused, but
let me demonstrate everything in Excel because this is a hard topic. So the next topic that I had was the annual reports and stuff, but I think it'll be better if I actually demonstrate everything in Excel. If people, what do you guys want to do? Do you guys want me to move on or Excel stuff? You can just send me a quick chat.
I think Excel and stuff would definitely be beneficial.
I agree.
Okay. Awesome. Let me just stop sharing. Okay. So it'll be a refresher for all the people who attended last week's session. Okay, so can you guys see my screen? Okay, perfect. So we'll start with the income statement. So revenues. Actually, could anyone tell me what the line items are for the income statement? No. Okay. So revenues.
Can you clarify what you mean by line items? So just any lines on the incomes?
Yeah. So revenue is a line item. COGS is a line item. Yeah. Sorry. I should have made that clear. So any row of a particular statement is called the line item. So we have the revenues, we have COGS, which is cost of goods sold. We have gross profit, and then we have SG&A. Then we have EBITDA. And then we have depreciation and amortization. And then we have the EBIT. Then we have interest expense. And then we have EBT. And then we have the taxes, and then we have net income. And then we have dividends. Okay. So I explained everything in last week's session. So if you want to understand something, I'll be happy to explain it, like anything again. But it's usually recommended if you are attending a session that you watch all the previous recordings. But again,
so just to clarify, sorry.
Yeah, go ahead.
No, sorry, I didn't want to interrupt. So kind of the way I'm looking at this is, for example, for EBITDA, we have EBITDA, and then we have D&A, which we subtract. and then we get to EBIT, right? And then we subtract from EBIT interest, and then that's how we get to EBT, and then we subtract taxes. Yeah.
Absolutely. Yes, absolutely.
Okay. So you're kind of moving down, subtracting more and more from the revenues.
Exactly. So this is the only positive item on the income statements, the revenues. So it is what you generated, and then these are all the expenses. So the COGS is an expense, SG&A is an expense, D&A, interest expense, and the taxes. There could be one slight difference here. There could be also interest income. So if you have given some loan to some other company and they pay you some interest, that could also come here. So that'll be added and not subtracted. But usually it's just the interest expense. And everything else is everything else is deducted. So the balance sheet. Assets. We have current assets. Actually, there's no, current assets. Current assets. And then we have liabilities. If you don't understand some particular account, just text me on Zoom and I'll be happy to explain it. But I covered all this in last week's session, so that's why I'm going over this all kind of fast. Operations, cash flow from investing, cash flow from financing. Okay. So the first thing that we'll be looking at is the linkages between the income statement and the balance sheet. So this is the net income, which is the bottom line on the income statement. That flows into the shareholders' equity account in the retained earnings here. So maybe the retained earnings from last year was $1,000, and then this year we generated $50 more. So this year's retained earnings would be 1,050. So retained earnings is net income plus last year's retained earnings. Does that make sense? Any question on that? Okay, so the next, let me also reference my slides so that I go in the same order. Okay. Depreciation and amortization. Yeah. So here we have in the non-current assets, we have an account called the Ppne, which is all the physical capital for a company. So machinery or factories that a company has. So for example, if we bought some Ppne in the first year for $1,000, because accrual accounting says that we have to expense it over the life of it. So if the useful life is 5 years, so the depreciation every year would be 1,000 over 5, so $200. So $200 would be, so this is the Ppne schedule that we build for the balance sheet. So Ppne is here, and the Ppne schedule is down below. So the net Ppne is, for that year, it's 1,000 minus 200. And the next year, the net Ppne year 2 would be 800 minus 200. And in the last year, so after the 5th year, the net Ppne would be 0 because all the 1,000 would be expensed through the depreciation every year. So we build this Ppne schedule, and more precisely in the non-current assets, we actually have the net Ppne. or the book value of the Ppne. That's the two terms used. So this depreciation is actually linked here. Or I can just, so the Ppne, depreciation amortization from the Ppne schedule on the balance sheet flows into the D&A on the income statement. Okay. And then here in the non-current liabilities, we have debt. So any interest expense on that debt is linked here. Here. Oh, sorry. Any questions so far? And then the last point is, let me see. Yeah, so here in the current assets, we have inventory. So for example, if we bought inventory of $100 units, and then we sold off 20 units, so that 20 units would go here, and the inventory would turn to 80 because we sold off the